answers again as much as possible, as precise as can be, so we can fit in all 5 pitches. Shay, are we online? We're online.
Okay.
We're all set. Everybody ready? All right.
All right. Hi, I'm Mary Kate Simon, and I'm a junior in the AIM program, and I cover the international consumer discretionary sector. Today, I will be pitching Japan Airlines, ticker JAPSY. Before I start, I want to point out that my insider holdings is wrong. It says 703%, but it's supposed to be 7.03%. Japan Airlines operates as a global provider of scheduled and non-scheduled air transport, aerial work, and aircraft maintenance services. JLL provides flights in 349 airports in 52 countries globally, with the main drivers of revenue coming from Japan, the US, and China. Now on to my recommendation. Japan Airlines is an established leader in the Asian airlines industry and is poised to capitalize on the need and prevalence of increased air travel into and out of Japan. After going bankrupt in 2010 because of weak management and $25 billion in debt, JLL restructured and implemented a widespread marketing strategy that gave rebirth to the flagship carrier. JLL differentiates itself from its peers through their continuous adoption of the newest technologies, joint ventures, creations of new aircrafts, and an increased emphasis on customers. In 2018, TripAdvisor, the world's largest travel website, named JLL the best airline in Japan for the second consecutive year for doing just that. Although flight safety and on-time operations are JLL's most important customer commitments, JLL revenues are growing at a CAGR of 4.86%. Japan Airlines took steps to create value one step ahead of competitors, such as offering free in-flight Wi-Fi services on domestic routes, establishing a fintech company, and investing in Boom, a supersonic passenger aircraft developer. Given JLL's competitive advantage within customer satisfaction, their steady revenue stream due to an increase in both flight frequency and destination numbers, and increasing demand for Japan travel, it is recommended that Japan Airlines be added to the AIM International Equity Fund with a price target of $23.88, representing a 29% upside. Now on to my drivers. The first one is that Japan is a hotspot. Japan is experiencing promising growth in the airline sector, and Japan has become one of the world's fastest growing travel populations. Since 2013, Japan has experienced a 234% growth in overseas travelers and recently reported an increase in international passenger revenue, up 11.5% from last year. Along with the fact that the 2020 Olympics and Paralympics will be held in Tokyo, it creates a highly positive demand outlook for JLL. The second driver is customer service improvements. JLL continues to improve in customer satisfaction as they introduce new airplanes, upgrade airport lounges, expand the numbers of routes with in-flight Wi-Fi, and introduce new menus. In addition to making their customers' in-flight experiences better, JLL recently collaborated with a travel website to help create an Airbnb-style experience. This website allows JLL to provide travel content on lesser-known local sites and events to incoming travelers to Japan. The Airbnb-style experience not only differentiates Japan Airlines, it allowed them to create a new product that combines air travel and Japan-style housing accommodations. My third driver is increasing flights domestically and internationally. Japan Airlines focuses on expansion in the international market. They have launched new services between Tokyo and Melbourne and Tokyo and Kona. Additionally, the Japanese government and the US have been negotiating a new route to increase both the number of flights and takeoff and landing slots. Moreover, Japan Airlines is continuing to increase flight frequency both domestically and internationally, specifically on the late-night service to Japan and Europe. JLL also made numerous partner agreements. I'm going to skip my valuation and management for the sake of time and touch on my risks. Japan's shrinking working age population is my first risk. Japan's age population is facing a steep decline, which proves a market risk for Japan's domestic passenger operations. Domestic flights for Japan Airlines account for 85% of their total flights. However, there's growth opportunities ahead, such as the increasing inbound demand from the 2020 Olympics and Paralympics. The second risk is disaster risk. The majority of Japan Airline passengers use the aircraft that depart from and arrive at Haneda and Narita airports. Consequently, In their airport transportation business, these airports play a vital role. A major earthquake or volcanic eruption in the Tokyo area could lead to closures in these airports. The third risk is oil prices. Although oil prices are currently decreasing, the uncertainty creates a risk for Japan Airlines. Fuel prices may factors a major operating expense for Japan Airlines. Therefore, if they rise, it could negatively affect the company's margin. I now open the floor to questions.
All right, here we go.
Can you talk about your decreasing operating margin but increasing EPS?
Yeah. So historically, they have had an increasing operating margin, but at the same time, their operating income, but their margins have decreased and their EPS has risen, which is kind of confusing. But it's because their revenue will continue to grow because of their new investments with their fintech company and the Airbnb, and also the outlook for the Olympics. When Utah had the Olympics, it caused a huge spike in revenue and flights there. So I think that will continue to grow. Their operating margins have been shrinking because of the fact that the taxes there have been increasing, and also they continue to spend a lot on R&D.
Jane,
Do you guys hedge your oil?
Yeah, we hedge 40%. They hedge 40% on their domestic flights, which accounts for 40% of their fuel. And on their international flights, which accounts for 60% of their fuel, they do a fuel surcharge, which basically just puts the prices on the customers, and that like evens it out.
So you mentioned that that management was the cause of their 2010 bankruptcy. What is the new management doing that'll prevent them from doing that again?
So they've actually recently decided to not have a CEO. They kind of have an amoeba system where they work together to make decisions. And since their bankruptcy in 2010, they've continued to grow, and they've proved that their new management style is effective for the company.
What's your country risk premium?
It's about 7.2.
how much?
7.2.
7.2. That would be tacked on, I mean, the US country risk, US equity premium is like 5.5.
Mhm.
So the 7.2 that's the difference. Did you add 7.2 on top of your,
On top of the US's?
Yeah.
No.
okay, just the incremental?
Yeah.
Okay, good, thank you.
I know there's a lot of interest on short interest. I know it's not on your box. Do you know it or?
I'll get back to you on that.
Jake,
So one of your airplanes skidded off a runway, and then you've also been flagged for your flight attendants flying under the influence. So like, how can we trust your company to just be safe?
Yeah, so last year, one of the flight attendants did get in big trouble for failing a breathalyzer test, and Japan Airlines took steps to basically fire him or her, and they are taking their biggest priority is safety. So their management strategy is to continue to increase their safety.
Just touching on your second risk, in the past, has there been any damage to the runways or airports or airplanes?
In 2016, there was a major hurricane that did cause one of the airports to close for like 2 days, and it affected just a short span of time, but they ended up overcoming it.
Is Japan different than the United States and Europe, where you mentioned they're planning on increasing their flight costs? So are consumers okay with that, rather than like the budget airlines that are kind of taking the share away in the United States and Europe?
Yeah, I kind of disagree with that, because I think that even in America, like obviously like college students are looking for cheap flights, but I think that it's more about convenience rather than price. And I think that the population of Japan is looking for a more comfortable, convenient flight experience.
I see that in 2017, you guys had like a fraud issue with email fraud. Was that part of like the management, do you think, or can you like comment on that?
I know, I did read about that, and I think that that was a management error, but I think that they are focusing more on technological advances in their partnership with their, well, they actually created their internal fintech company, which is also gonna help, like asset management, like through that, so.
We did have one sent in here. There's been a noticeable decline in operating margins kind of consistently. What's the company doing to address that?
Yes, their operating margins have been declining, and that is due to their R&D, and I think a lot of that was the $10 million investment on Boom. And in order to supplement that, they're gonna continue to try to expand their revenue with the Olympics and stuff.
Ben, can you ask a question in 10 seconds?
Yeah, what's their value add over other Japanese airlines?
Their improved customer services.
All right. Again, thank you. That was fast. That was good. Keep it up. All right. Here's Nick. All right.
All right. Hi, everybody. My name is Nick Arco. I'm a junior in the AIM program, and I cover domestic technology. So today I'm going to be pitching Box, ticker BOX. So Box is the most comprehensive provider of cloud-based enterprise content management solutions. Its software as a service platform allows users to view, share, and collaborate on content with both internal and external parties. The company derives 78% of its fiscal 18 revenues from the United States, and it was founded in 2005 and is headquartered in Redwood City, California. So on to my recommendation. In 2018, Gartner named Box a visionary in cloud and content services platforms and the leader in content collaboration platforms for the 5th year in a row. This is ahead of both Microsoft and Google. Their single unified platform differentiates themselves from legacy ECM players like OpenText and more basic offerings like Microsoft. The company allows a variety of add-on products ranging from data migration and consulting to the ability to customize applications to specific businesses. Additionally, the company offers numerous security and governance and compliance products, allowing them to sell into highly regulated industries, a space where many of their competitors lag, and helps them to develop a competitive edge in international markets. These features comply with FedRAMP, FINRA, HIPAA, GXP, and the new GDPR regulations, among others. Overall, their expanded product suite has led them into a TAM, total addressable market, of $45 billion. Currently, they have 11.9 million paying users, which represents about a 36% increase since the beginning of 2018, and 90,000 paying organizations, including 69% of the Fortune 500. The company has seen sales grow at a 30% CAGR since 2015, and they're poised to exceed $1 billion in revenues in fiscal 22. Box has recently revamped their go-to-market strategy, shifting focus to solution selling and building deeper customer relationships. They have increased their number of quota-carrying sales reps, about 18% so far in fiscal 19, and shifted incentives towards add-on selling and increased segmentation of their sales force. This approach has paid off as the company has seen a 42.5% increase in six-figure deals in Q3 versus the same quarter a year ago. The company's sales and marketing expense has been a main reason for their negative EBIT, but as they continue to enhance productivity, leverage online sales channels, and leverage free user marketing, the company expects to see it fall as a percentage of revenues going forward. Because of this company's strong future, Box is recommended to be at the AIM Small Cap Equity Fund with a price target of $35.25, representing a 51.4% upside. So on my thesis, so this is a rare growth opportunity, as consensus estimates peg revenue growth rates at an admittedly conservative 20% in the medium term, which is uncommon among cloud-based software as a service companies. On its way to $1 billion in sales, investors have significant visibility into their revenues as they have a 4.5% churn rate, leveraging AI ML technology. In 2017, the company introduced Box Skills. Prior to this, there was no easy way for businesses to apply artificial intelligence and machine learning technology to their massive amounts of unstructured data. With technologies like image labeling, speech-to-text transcription, and natural language understanding, the goal of Box Skills is to help companies understand and structure their data. The company believes that these early-stage products will be key in attracting new customers and growing current account value. Strategic partnerships. Box is a highly versatile platform that can be integrated with more than 4,500 existing applications. Their largest technology and reseller partnership is with IBM, who they co-developed Box Relay with. It's a product that allows businesses to automate workflows. First, from a sales distribution standpoint, IBM played a role in 6 deals worth 100,000 or more in the first quarter of this year. The element to this partnership is the exposure to international markets that Box gets through IBM. In 3Q, 25% of their revenues came from international sales, which is up 4% from the year-ago quarter. Box can also be integrated with Office 365, and sales reps from Microsoft began being compensated for selling Box within the context of Azure at the end of 2017. Box can also be integrated with Google. Their products like Docs, Sheets, and Slides, which allow companies to use these tools while still benefiting from Box's admin controls, security, governance, and compliance. I'm going to skip over valuation and risks just for the sake of time and touch on management. Aaron Levy is the CEO and chairman of Box since founding the company in 2005. Dylan Smith is another co-founder. He's the CFO and also director of Box. And Stephanie Carullo is COO at Box, and she leads their go-to-market strategy. Prior to joining Box, she held similar positions at Apple, IBM, and Cisco. All right, I can open it up.
Okay, and then repeat questions or summarize them if you can. Arsh is concerned about the ROIC being less than the WACC. When does that go to a reverse situation?
Yeah, so I think that we should start to see that kind of come up in calendar 2022 is when they're going to go profitable. That'll be fiscal 2023. So yeah, the reason that ROIC is negative obviously is because they've got negative net income, but once they start to go profitable, that's when it turns itself around.
All right, I got 2 questions. The first is, can you touch on what happens to your valuation for EV to sales when you take out service now? Because it seems like a pretty bigger company, and it kind of seems like the 11.3 is kind of dragging that average up.
Yeah. So what happens to my valuation overall when it gets taken out? The valuation drops about $2 overall. The reason I included ServiceNow is because they've got a really similar business model in that they get most of their revenues from subscriptions with a small amount coming from service, which mirrors Box pretty closely, as well as the fact that they're a cloud-based company that sells into large enterprise customers, the same as Box does.
Quick follow-up.
So can you touch on your balance sheet due to their high debt to equity? Just kind of curious.
Yeah. So that 383 number is deceptively high. They've got really low equity because they haven't had a profitable year yet, so their retained earnings is really high. But they don't have a ton of debt. They've got about $40 million on the balance sheet right now, coming due in 2020. But they've got about 200 million of cash on the balance sheet, so they're well positioned to be able to pay off that debt if they choose not to restructure it in 2020 when it comes due.
Gino.
Why do you think now is a good time to invest as opposed to 2022 when they're actually
So when they restructured their go-to-market strategy, the sales growth estimates dropped from 30% to about 20%. 30% is where they were historically, and I believe that this isn't priced into the market yet because when there was that drop from that 30% growth rate down to 20%, the stock dropped a little bit, and I believe as people start to get comfortable with that 20% growth rate, which is still pretty high, they should be able to. We'll see an increase in the stock
Quick
price.
follow-up. You have 20% growth for 2019, 2020. What's it like in 2021 and then that profitable year?
Yeah, 20%. That's how I modeled it. Yeah.
All 7 years?
I dropped a little bit at the end, but
What is it end?
through about 5 years, it's dropped to about 19%.
Bill.
You just, given how long it's going to take them to be generating a positive net income, can you talk about what their burn rate looks like?
Yeah, their burn rate, I don't have a number on the burn rate, but I can get back to you on that.
Question was over here. Who had a question?
I'm just curious for the Box skills, what are maybe some other products in the space or competition in that space?
Yeah, so there's not a lot of products out there similar to Box skills in that you can, obviously there's plenty of AI machine learning technology out there, but in terms of being able to apply it to content that that large enterprises see coming into their business on a day-to-day basis, which is obviously massive amounts, and it's all unstructured. There's not much in terms of being able to apply it to that content. So a good example of something that you can do that I think is easy to kind of wrap your mind around is you could, for instance, take a video and then set up technology through Box that would allow you to search for a word in the video. So you could search for where somebody said like the word box, for instance.
Clarissa.
Yeah, so on Tuesday there was
Repeat the question.
what? Oh, sorry. Yeah, she asked why the stock kind of popped a little bit in the last week. So Tuesday, Goldman Sachs initiated coverage on it. They put out a $31 price target, which represented a 44% upside at the time. And it caused the market to kind of buy the stock a little more. So
Patrick
it
Keo
jumped.
again is concerned about the debt equity ratio.
Yeah, Patrick, the debt equity ratios, because they've got low equity, but not a lot of debt, it's just kind of deceptively high. They answer that.
Can we do another question? Kevin, got a question? Michael Vinovic says that you have legacy ECM customer base representing
Yeah, the
an
8 to 10 billion.
opportunity. Isn't this already in your total addressable market? And if so, does this hurt your thesis a bit?
Yeah, so the 45 billion does not include that 8 to 10 billion. Where the 45 billion is coming from, there's a few different spaces that Box competes in, but that 8 to 10 billion is coming from companies that have not moved over to cloud computing, and where that comes into play is they could possibly move into that space, and there's an expectation that in a few years most will.
All right, Nick, thank you. Okay, moving right along, our second of 3 Japanese stocks today. Andrew. Okay, Andy, here we go.
Hi, my name is Andy O'Neill. I'm a junior in the AIM program covering the international consumer staples sector. Today I will be pitching Ajinomoto. Ajinomoto operates in the manufacturing, distributing, and sale of food products, amino acids, and feed use products. Food manufacturing and processing operates in seasonings, processed food, sweeteners, and frozen food items. Animal feed manufacturing produces amino acids for feed use, and diversified development and manufacturing services manufactures and sells amino acids and other pharmaceuticals. Ajinomoto generates revenue from Asia and the Pacific, the Americas, Europe, Africa, and the Middle East. Founded in 1917, the company went public in the Japanese stock market in 1949 and is headquartered in Tokyo, Japan. I'm going to skip over my recommendation for the sake of time, and so now on to my drivers. First driver is Consolidated Logistics. Ajinomoto recently agreed with 4 other food-producing companies in Japan to merge their logistics operations, establishing a nationwide logistics company. All 5 companies will discontinue their logistics divisions and form a new one. This will lead Ajinomoto towards lower costs in that area, and they will be able to increase their earnings per share. The loss of control of Ajinomoto Logistics will be recognized in April 2019, and that division is classified as a discontinued business in first quarter 2019. Ajinomoto Logistics Corporation, owned by Ajinomoto, ended fiscal year 2018 with revenues of $572.2 million and had net income of $21.3 million, yielding a net income margin of 3.7%. As a whole, the company operated a net income margin at 6%. Taking this out of the business and operating it separately in their largest geographic market will increase their income margins past 6%. Amino acid growth. In the healthcare section, the firm's sales of amino acids have soared, up 14.6% in 2018. The company is known as the largest producers of amino acids across the globe. Ajinomoto produces 20 amino acids in 27 different locations around Japan and the rest of the world, and they continue to expand their research and development to stay on top of the newest technology. They have recently shifted their research towards cutting down waste through new technology, maximizing the productivity through fermentation. This has the potential to lead to increasing profit margins. With almost 21% of sales coming in amino acids for either human consumption or feed use, this segment continues to grow in double digits each year and is a large part of their organic growth. CITIC joint venture. In November 2018, Ajinomoto announced the sale of Amoy Food Group to CITIC Capital Asian Foods, a Hong Kong-based company specializing in flavoring syrups and concentrates. They received 15% of CITIC Capital Asian Foods in return for Amoy. The Amoy brand is known as the #1 soy sauce brand in Hong Kong. The deal will be closed in second quarter 2019. The market for soy sauce is expected to grow 28% by 2022 in Hong Kong, and pairing with CITIC will help Amway keep their place as the most popular soy sauce brand. Amway currently holds 36% of the market share in that country, and CITIC will increase their brand recognition further in hopes to increase their market share. And now onto my valuation. In order to reach an intrinsic value for Ajinomoto, a 5-year DCF model was constructed. Using a terminal growth rate of 1.5% and a WACC of 5.11%, an intrinsic value of $21.15 was reached. A sensitivity analysis on the terminal growth rate and WACC ranged from $18 to $25.37. Additionally, a price to earnings multiple valuation was calculated. Using a 2018 average peer PE multiple of 16.33 times, resulting in a relative value of $20.66. An EV to EBITDA multiple valuation was also conducted using an average peer multiple of 10.21 times, resulting in a relative valuation of $23.26. Weighting the models 40, 30, 30 resulted in a price target of $21.64, resulting in an upside of 23.56%. Ajinomoto's dividend yield in 2018 was 1.2%. Now onto my risks. Acquisition failure. Ajinomoto has had more inorganic growth than organic growth in recent years due to making large acquisitions. They have experienced failures in the past, and continuing failed acquisitions would cause decreasing margins in the future. Seasonality. Ajinomoto tends to be slightly seasonal, as they have had higher sales in the fourth quarter than any other quarter for each of the past 4 years. While the gap in sales is not very large, if fourth quarter sales were to slip or the economy undergoes a significant downturn during the fourth quarter in the future, it could have a larger impact on their business than any other quarter. Slow Japanese growth. Ajinomoto has 43% of sales coming from Japan, and Japan is a country that is growing slowly. The World Bank projects their GDP growth for the years 2018 to 2020 of 1%, 0.8%, and 0.5%. If these slow growth projections come to light, they will need to find a way to outpace the overall economy to enjoy large growth. I will be skipping my management section for the sake of time today, so I will open up the floor to questions.
Okay, right here.
So the stock in the last few days has dropped 17%. They just announced like a Q3 loss, lowered their forecast for the year. In the past 2 quarters, they've seen decreasing net income. Can you just kind of comment on that, what you see going forward?
Yes, a lot of the decreases in earnings and missing their earnings projections come from a failed acquisition that they made. They tried to acquire a Windsor Food Company, which is a U.S. frozen foods company, and to hopefully expand that. And it did not go very well for them, and they lost a lot of money on that. And so they've experienced a little bit of a downturn, which has lowered the price of their stock quite a bit.
Can you touch on their WACC and maybe why it's so low? And then just with that, what did you use for their country risk premium?
Well, their country risk premium I calculated at 7.38%. That was not on top of the 5.5%. So it would be about 1.87% was my country risk premium that I used. And then my WACC I calculated a 4.77% WACC using data from FactSet. Bloomberg has a WACC listed at 5.2%, and using a weighted WACC between my calculated WACC at 20% and the Bloomberg WACC at 80% led me to a WACC of 5.11%.
Yeah, the company has had some product recalls in the past. Can you comment on that? And see if there's a problem
Try to repeat it.
forward?
Sure. In the past, the question was referring to product recalls in the past. Yeah, a lot of their product recalls that they've had in the past have had to deal with brands that they've acquired, which have been part of the reason that they've experienced some acquisition failure. And their plan for the next 3 years from 2018 to 2020 has been to sort of sell off some of these acquired businesses that they bought, just trying to make a bigger company. They're trying to make it so that they're more focused on their core competencies and can focus on not having recalls.
Yeah.
All right, so just looking at your box for your estimates, you see like 3 to 5% growth for the top line, and then we're seeing just minimal to even -% growth for operating income, leads to a declining margin. Can you kind of comment on that?
Yeah. So again, their strategy for the next 3 years, like I talked about, is that they're trying to sell off some of these companies that have been they've been increasing their sales quite a bit, but they've actually been tanking their margins. And so I wanted to be a little bit conservative on their margins. Their projections have their margins increasing by a lot more than I have them at, but I felt that in order to be fair based on their history and what they've shown so far, that I need to be, that they need to be lower than they were.
Questions?
Your company's a producer of MSG, so do you feel like moving forward, as people start to live healthier lifestyles in America, their revenue in America will be affected?
I think that it is possible that their revenues will be affected. They really do. Their company motto is "Eat well, live well," and they've recently implemented integrated food solutions where they've been using their amino acids and combining that with their food products in order to make healthier food products. And I think that as people start to live healthier in America, that can help their American sales.
Yeah, for the consolidated logistics driver, do you see the earnings per share growing at a higher rate than other analysts? And why are you thinking differently than the market does, considering information on this is already out there and available?
I think that it will have a big impact on them because I think that they've been operating that at a pretty bad margin, and in the past, and the information is available to everyone else, but I think that the projections are a little bit low for
Bill Walker's joining us online. Hi, Bill. Hope you're feeling better. Trading pattern, he's asking about the stock and the thinness of the trade, the liquidity. Any comments?
Yeah, it has been, the volume on the trading has been a little bit low. They've, over the past 6 months, their average daily trading volume has been 2,460. It has been low in the past.
Okay, last question, Edward.
For your third driver with the joint venture, I understand 15% of CITIC or whatever it is specifically. Do you know how much revenue or sales that's going to add to Jenny?
Sure. So the Citic Capital Asian Foods brand, they had their revenues were 8.4 billion for 2017. 2017 was the most recent year of data that I could find, and their net income was 1.7 billion. So approximately 15% of that would be bolstering their sales and net income margins.
You got an attaboy from Bill Walker. Good presentation. Thank you. All right, back to the States, BJ, right?
Yep.
All right, hello everyone. My name is Paul J. Cox. I'm a junior in the AIM program and I cover domestic consumer discretionary. They'll be pitching Gray Television Inc., ticker GTN. Gray Television is a leading player in the television broadcasting industry, owning and operating television stations and leading digital properties in 91 television markets, including the first or second highest rated television station in 85 of the 91 markets. The firm operates out of the United States and operates in 3 main segments: broadcast advertising revenue, which can be further broken down up into local advertisements, national advertisements, and political advertisements; retransmission fee revenue, which makes up about a quarter of their revenues; and other, which includes things like studio rental revenue and equipment rental revenue. Gray Television was founded in January 1897 with the creation of the Albany Herald in Albany, Georgia. After acquiring several local newspapers and television stations over the last century, the firm was purchased by James Harrison Gray Sr. and is headquartered in Atlanta, Georgia. Gray Television has proven to be a leader in the domestic broadcasting market, as GTN has experienced a 5-year sales CAGR of 16.9% and operating income CAGR of 18.2%, while operating with a 5-year average gross margin of 40.63%. GTN has also launched several successful digital media initiatives, including amassing over 4.1 billion total page views in second quarter 2018, with 85% of all digital traffic coming from mobile devices. As of this past August, GTN had over 10.8 million news and weather app viewers and 2 million iOS downloads, as well as 2.1 million Android downloads, up 27% and 10% respectively from August of 2017. These digital media initiatives present a unique opportunity to diversify revenue streams and increase advertisement sales through non-traditional channels in the broadcast industry. Local market leadership positions with the #1 or #2 rated station in both audience viewership and news programming, and 93.4% of active markets help negotiate more beneficial terms in major major network affiliation agreements, helping to solidify its strong operating margins as well as enhance advertising revenue through price discipline and leadership. Additionally, Gray has been growing its presence in OTT streaming with over 459,000 unique users for Roku and Fire TV as of August 2018. GTN intends to maintain market leadership position through continued investment in news and syndicated programs to ensure favorable terms in major network affiliation agreements expiring at various times throughout 2023. I recommend GTN is added to the AIM small cap portfolio with a price target of $22.56, representing a 36% upside. Now I'd like to move on to my investment thesis. Last year's 2018 election spent a record amount of money on advertisement for midterm campaigns with over $4 billion invested in local broadcast, cable, and online, with the bulk of the dollars being spent on local television, slightly over $3 billion, representing a 29% increase from 2014. A top-rated news platform coupled with locations in key swing states allows for market leadership positions and enhanced advertising revenue through price support. In the 2016 election, GTN averaged $9.63 of political revenue per TV household, compared to $5.03 from its closest local competitor in the category Nexstar. Political spending, coupled with Olympic advertising, is expected to continue to increase, making 2020 an explosive year for the company. FCC rollbacks. The FCC recently eliminated the media cross-ownership ban while simultaneously increasing the number of television stations a company could own in a local market, making it easier for a company to own 2 of the 4 largest stations in any given market. M&A activity is a key part of GTN's corporate strategy, and the regulatory rollbacks will allow management to continue to pursue growth opportunities. This ultimately allows GTN to continue its merger strategy and aided GTN in completing the Raycon transaction earlier this year, which I will touch on briefly right now. The transaction completed Gray's transformation from a small regional broadcaster to a nationwide media company with a national scale. The acquisition nearly quadrupled Gray's nationwide market share, going from a reachable audience of 6% to American households to ability to broadcast just under a quarter, 24% of households nationwide. The combined company now has 142 full-power TV stations in 92 markets, making it the 3rd largest portfolio of stations and markets in the United States. The C-suite or the management estimates $80 million of the year 1 annual synergies. Additionally, the acquisition allowed GTN to handle national sales in-house at former Raycon stations, allowing them to reduce expenses by an estimated $11 million a year. My last driver is raising retransmission fees rate. Retransmission fee revenue makes up approximately a quarter of GTN's revenues. The Communication Act of 1992 requires that a television station give its consent to a cable system or multi-channel video programming distributor to carry its broadcast signal. This act gives broadcasters price control over their programming, charging large fees to cable companies to carry their content or face a television blackout of Big 4 programming. These retransmission fees are expected to rise an average of 88%, from $11 per month per subscriber in 2017 to $19 per subscriber per month in 2020, according to the American Cable Association. GTN's position is either number 1 or number 2 rated network for news and audience viewership in 93% of its markets, gives them even more negotiating power with cable companies. I will skip my valuation in order to preserve time. Some risks are television programming purchasing. Television programming has to be purchased in advance of whether knowing a program will be popular enough to recoup the investment into the programming, which could potentially harm their ratings. GTN carries a substantial amount of debt and has the ability to incur a substantial additional debt. Principal and interest payments may restrict future operations, and the business is fairly highly cyclical with advertising revenues, which are seasonal, and economic depressions may change operating income.
Good. Ben?
So this FCC rollback obviously is a really good thing for the company. How will they acquire more companies? You know, they have a lot of.
So that's they generally their strategy. They do take on a lot of debt, and then as soon as they take on the debt to acquire companies and stations, they focus on deleveraging. So from 2014 to end of 2017, they were levered about almost 6 times, and in that time they've been able to deleverage significantly. So I don't necessarily see having a ton of debt as an issue for them.
Can you talk a little bit about your comps, specifically Sinclair and Nexstar, assuming that they're nearly double the size?
Yeah, so they're all double the size, but the broadcasting industry is extremely consolidated, so it's kind of hard to find comps that are all the same size, just because the industry is characterized by such high levels of merger and acquisitions. So companies can gain and kind of amass market share pretty easily, which is going to have a big effect on market.
So this might just be more of a curiosity question, but why price to cash
So yeah, I did price the cash flow because cash flow is such a big part of how they plan on deleveraging. And if you look at their competitors, they all are extremely leveraged. So I just figured that was an appropriate relative valuation comp because of how levered all the companies are.
John, then Michael, then Eric. Yeah, so just for I see you have revenues growing at almost 90% from 2018 to 2019. Is that in anticipation of the 2020 election or?
No, so that is priced in with the merger. So the merger actually closed 3 weeks ago. So again, they're almost going to quadruple their market share, and I kind of based that off of pro forma numbers that the company released upon the acquisition of the company. So I wanted to be fairly conservative with my estimate, and this is even, I think, a fairly conservative number. Incorporating the pro forma revenues from Raycom, which is a private company. So that's kind of where that growth is stemming from.
Michael.
Yeah, really quickly, you have a consumer discretionary company. I'm just wondering why you use the price to book multiple banks.
Yeah, I used price to book because it is fairly asset intensive. Their broadcasting licenses alone are worth $1.5 billion as of 2018, as well as they're operating basically massive broadcast stations as well as retransmission stations and things of that nature.
Eric, so looking at your box between 2017 and 2018, operating margin increases and then EPS is cut in half. Is this due to like a share issue?
So that was due to 2017. They had a pretty big tax benefit because of the rear-end tax laws. So that's kind of just what that's from.
Steven, last question.
Just out of curiosity, do you know their organic growth rate by any chance?
So I do not know their organic growth rate, but I know it's extremely hard to grow organically in the broadcasting industry because the FCC only grants a certain number of licenses. So unless you can somehow create a license, which is next to impossible to do without getting one from the FCC, the industry is just extremely consolidated in terms of merger and acquisition. So I'd imagine it's next to nothing.
All right, PJ, thank you. All right, Clarissa works her way up. Thank you. This was a lightning round presentations and questions today. That's good. I mean, we'll take our time to process this. The 5 of you who presented, begin to think about what your buy and sell recommendation will be. I'd like to get that information tomorrow and get a ballot out early. Okay, everybody, one more to go. This is Clarissa, another Japanese company, right? Third one today. Yeah. Yeah,
Okay,
please.
perfect. Hello, I'm Clarissa, junior in the AIM program, studying finance information systems. My company is Sysmex. They're a leading player in the development and manufacturing of clinical laboratory instruments. They're headquartered in Kobe, Japan, and operate in four segments: in vitro, diagnostics, equipment, maintenance services, and other. They drive their main revenue from Japan and China, and the rest they get from the Americas, Europe, Africa, and the Middle East. On to my recommendation. The global market for in vitro diagnostics is currently $53 billion and expected to grow 9% per year. Sysmex is currently entering the surgical robotics market, which is expected to grow $13 billion by 2020, a 12% CAGR. The firm holds 60% of their hematology market share in developed markets alone and expected to see market growth within China. Sysmex is currently launching FlowFish, which is a testing method which samples over 10,000 cells and helps test them within 10 minutes. With blood test sampling, also chromosomes levels. They also diagnose leukemia through this testing and abnormalities. In 2019, Japan approved the medical use of robotics and their use of testing for prostate cancer. Onto my investment thesis. They plan to increase their sales in China as their demand for diagnostic testing grows within their healthcare sector. Along with that, we see them seeking innovation products to recently launched a FlowFish and herbicide products to help diagnose patients. They also received manufacturer approval onto their Arco guide, which helps profile the cancer cell genes. $11 billion market for SSMXY, which is expected to grow 9%. If they receive 5% of this growth, they'll roughly have $800 million in revenue by 2020. Onto my valuation. My price target is $34.47, which is a 21.32% upside.
This is compromised of intrinsic value target of 29.62. My PV ratio is giving me a price of 28.91, and my EV to sales, which gave me a 29.43. My EV to EBITDA, which gave me a 32.47, and I weighed them by 40, 20, 20. I'm opening the floor to any questions.
Okay,
Could you maybe talk about why you included included surgical on your peers, given that they're almost 5,000?
So that's a really good question. The reason why I did that is because they already are in the robotics field. And I thought it just because it's so advanced that eventually maybe they could be equal to that as they continue to grow into that system.
Did you weight all the peers equally when you weighted them?
Yes, I did, because they all were really similar with each, like, diagnostics. There's like one, for example, that works just like on platinum, which is blood, just with blood counts. And we have a lot of products similar to that, but we diagnose it versus they kind of help bring the plasma to the blood count to the patient.
Great.
Yeah, so your operating income is growing, but your margins are still the exact same.
Yeah, because they do a lot of, yeah, of course. So they do a lot of R&D. They find that really important. So they are constantly reinvesting all their money, but they really don't have that much debt. So they're actually using their money that they make and reinvesting.
Who is that? Nick?
Yeah, so another question about your peers, Haemonetics, sorry, their PE is pretty high, and if not for them being included, your peer average would probably be lower than your PE. Can you just touch on why that one is a good count for you?
So how I said before, we have a lot of products that are just in blood tests and like breaking up blood cells and counts like that. And we have products that with them that are directly competitive. So that's why I thought they would grow really well to that.
Jimmy.
To you personally, why do you think it's so important to diagnose?
Because I think as like we progress into the field, it's so much easier to help treat issues before they become critical. And I feel like everyone else is kind of seeing that feed into their healthcare system, and they're demanding healthcare providers who provide that right away.
Do you know what their success rate is with high volume?
Yeah.
High frequency?
So
Fast acting?
it was like around 95% on their thing. They did see recently with another product, they had recall, and just like a normal prop company, they recalled it immediately and just took it off the market.
Yeah. All right. So your first driver, why is that a driver?
So because they're expanding into China, where China before didn't have a lot of demand for diagnostic testing, which now they are seeing more and more of. So they've had products there already, and now they're deciding to add more reps over there to help increase.
So the driver is adding.
So they're adding. So like they've been working there already. So now they're increasing their sales reps of 200 in China to help meet their demand that they're having. Before they weren't able to meet the demand of the product sale.
So then all of your drivers are wrapping around the one SSMXY.
So yeah, they're all like different product lines that they help with joint ventures, and they all have different reasons to help grow the company. So like some are diagnostics, some are prevention, and some are like helping like treat. And they're trying to help grow their diagnostics over there.
Yeah.
Yeah, so I'm seeing DCF, your DCF got you an intrinsic value of around 29, your PE around 29, EV to EBITDA 32, and then 29 for EV to sales. And then your price target was 34.47, higher than any of them. Can you please talk about that?
So with all of that being done, we valued it differently with my 40% of my intrinsic value, 20 for the rest of them. And that's how I got the number.
Who's that? Gino and then Steve.
Sure. Just going off your risks a little bit, if you had like a third and fourth risk, like what do you think might also affect?
I think maybe their competitors, if they don't continue robotic testing more intensely, like their competitor from the US, which is intuitive surgical.
Steven? All right. If you had like another half page of space, what would you write about?
I would write more about like what each product does. It was very scientific based. So I thought that wouldn't be a lot of like actual worth value, just defining multiple medical terms.
Michael. I don't really have a question, it's more of a comment on just all the pitches today. Jess sends these out like a day early so we can all read them, and I don't, like, rereading your pitch is just, you can do that, you can read, so, like, prefer to see people talk about other things, in the pitch, or just, you know, add some more detail.
Yeah.
800 words or something like that.
Those are always a good, I mean, I'll add on to that. That's a good point. We do all read these. And so when you can come in and make a pitch, it's okay to highlight a few things, but don't read them, right?
We can do that.
Right. Tell the story. Clarissa, thank you. Thank you. All right, everyone, thanks for your attendance. A nice pace we kept to these. 5 write-ups. The buy-sell recommendations will go out this weekend. We like to always be able to transact quickly on Monday if need be, okay? All right, see you in fixed.